In this video, I'm going to talk about 7 mistakes people make with the 1031 exchange. So rule number 1 is about like-kind property. So you have the original property and you have the replacement property. They must be basically of the same nature. So they could be a different grade, they could be different quality, but they must also be located in the US. When they talk about like-kind property is that if you have a rental property, then you can exchange it with another rental property. If you have a restaurant, you can exchange it with another restaurant business. But you can't go and crisscross. You can go and take an apartment building and convert that into a restaurant and vice versa. In terms of the rental space, you could do multiple single-family rentals and roll them up into an apartment building. You can also break them up as well. You can also go from an apartment building and then break it up into multiple single-family rentals. Now, rule number 2 is about investment or business property only. There are all kinds of different things to consider in this. One of them is that intention matters. Intention actually is everything. And one of the primary criteria is the intent behind holding that property. So the property should have been held with the primary intention of getting some kind of income or revenue from it. Productive use. If the property was initially acquired with the primary intention of resale, if you're doing flipping, then it just doesn't qualify for 1031 exchange. Same thing with personal residences. They don't qualify because they're not held for investment purposes. They're not generating income. But we've seen people who own their house and they don't want to pay the capital gains tax. So what do? They rent it for 12 months and then they do a 1031 exchange. But the problem is that what is the intent here for these people? Is the intent for them to generate rental income with their house, or is the intent for them to avoid paying capital gains tax? I think the intent is pretty obvious that it is to avoid capital gains tax. In this situation, it won't qualify for 1031 exchange. What could happen is that they can go through the paperwork and everything seems fine, but the IRS could eventually come back to them and say, hey, this did not qualify. Now you have to pay all these capital gains taxes. You have to pay penalties and all that kind of stuff. Another one is vacation rentals. So vacation rentals must be rented for more than 14 nights a year in order to qualify. And you also must use less than 14 nights per year for your personal use. You make sure you want to maintain a lot of documentation with these properties to make sure that if the IRS comes in asking questions, then you are prepared for that. A lot of people are thinking, oh, this is my vacation property. I can avoid capital gains tax because I rented it for a couple of months. It doesn't work like that. You also have to not use it for more than 14 nights a year. So this is where the rubber hits the road there. Duration of ownership. A lot of people are talking about the duration of ownership and then that as long as you hold it for 12 months and it generates income for 12 months, then you're fine. But the IRS doesn't have a specific minimum holding period to establish the actual investment intent. Because you held it for a longer period of time doesn't mean that you had intention to get revenue from it. It's not just that. You have a stronger argument the longer you hold that property. Obviously, if you held the property for 5 years or 10 years, you have a very strong argument to say that you held it for rental income, but the fact that you held it for that doesn't necessarily mean that this is the intent. That being said, holding a property for a short period of time doesn't automatically disqualify you. So it may raise some red flags with the IRS, but as long as you have good documentation, you can still go ahead with your 1031 exchange. So many tax professionals are going to say, well, you want to hold it for at least a year and a day or something like that. But again, there's no particular requirement for that. It's really about intent. In order to determine intent, they would also look at the frequency of transaction, how many transactions you're doing, how many 1031 exchanges you're doing, how many properties you're selling shortly after acquiring them. And that might give you the appearance to the IRS that you are a dealer rather than an investor. And if you're considered a dealer rather than an investor, then the IRS could conclude that these properties are not really investment properties. They're more like an inventory or stock for trade. Then you would be disqualified for 1031 treatment. Rule number 3 is about the value. It's really about the transaction. So you want to move into a property, like-kind property of greater or equal value. So the net market value and equity of the replacement property must be the same as or greater than the original property. Otherwise, you'll have to pay capital gains tax on the excess. The rule number 4 is about the same taxpayer. Again, this is another one that people are confused a little bit about. It's not necessarily what's on title, it's really about having the same taxpayer. So the entity or person who sells, relinquish the property must be the same entity or person who buys the replacement property. This is to ensure the continuity of the tax obligation. When the property is held by an LLC, well, that same taxpayer rule is a little bit special. So we're going to make a differentiation between the single member LLC and the multi-member LLC. In the eyes of the IRS, the single member LLC is a disregarded entity. And the owner or the member, the single member of that LLC is the taxpayer. Because you're not filing a tax report for that single member LLC, you are, as an individual, filing that tax report. For that reason, it's typically acceptable for the single member of the single member LLC to sell the property, either held personally or by the LLC, and then purchase it individually or with an LLC on the other end, because it's seen as the same taxpayer. With the multi-member LLC, on the other hand, then consistency is key. It has to be basically the same members that are moving from one property to the next. The same members has to be selling the property, and the same members have to be buying the properties on the other end. So multi-members treated very differently, so they have to be on title for both of these properties. But the single member LLC, as discussed, you can have a little bit more of a mismatch because you are the taxpayer in that particular case. Rule number 5 and rule number 6 is really about the transaction itself. So 45-day identification window. So that's the rule number 5. So the property owner has 45 calendar days post-closing of the first property to identify up to 3 potential replacement properties. And then after that, rule number 6 is a 180-day purchase window. So the exchange must be completed no later than 180 days after the sale of the original property or the due date of the income tax return. So this is basically more transactional, but basically it's 35 days to identify the property, 180 days to basically close on the deal. And finally, rule number 7 is that you have to use a qualified intermediary. You have to use one to facilitate that exchange because the IRS doesn't want the taxpayer to touch the money between the sale of the property and the property that they're going to acquire in the back end, because they don't want the taxpayer to basically do something with that money in the meantime. Well, I hope you found this video helpful and it's going to help clear up some of the misconception and some of the mistakes that people are making with 1031 exchange. Every week I produce videos to help real estate investors and investors in general, entrepreneurs, on how to invest, how to achieve financial freedom, leave a legacy for their children, all that good stuff. If you like this video, make sure you click the like button. Make sure you subscribe to my channel so that you don't miss my next video, and see you next week.